Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, shares of Oracle are up 31% in the last month as investors pile in on the company's $455 billion backlog of orders, putting to rest any fears of a slowdown in that AI arms race. Following the money, I've found 3 stocks that are going to see a cash tsunami from the news. In fact, one of them is already up 57% this year, with much more to go. I'll reveal those 3 biggest winners on Oracle's cash bonanza, including the one I'm buying above all the rest. Stick around, and I'll also update you on shares of Intel, Nvidia, CrowdStrike Holdings, and show you in our market outlook why this bull market is set to keep charging. But first, I want to give you one last chance to get your tickets to our first meetups in New York and Chicago. I'll be speaking at the Blossom Investor Tour at the NASDAQ in New York on October 3rd, and then at the SIBO in Chicago on the 7th, and we'll have our Bowtie Nation meetups right after each event. I'll leave a link below for the tickets, which are going to cover food, drink, and free swag. Make sure you use code HOGUE15 for a special community discount. If you do think you can make it though, do not wait because there are a limited number of tickets available for each event. In the meantime, make sure you use the invite link below to join me on the Blossom app. I started using the app a few years ago and love it for sharing my portfolio and getting ideas from more than 400,000 investors in the social feed. It's all totally free to download, so make sure you look for that invite link below. On to our main topic though, and Oracle dropped a bombshell earlier this month, a $455 billion backlog of cloud infrastructure business that sent the shares up as much as 30% on that news, and proved the AI party isn't over, it's just getting started. But Nation, if you want to beat Wall Street, you cannot just react to the news, buying the headline stocks like ORCL. You can't just follow the money, you have to get in front of it. That's why I dug into Oracle's press releases, financial statements, and other research to find where that money is going. Nearly $500 billion in cloud business means Oracle is going to have to spend hundreds of billions to upgrade its data centers and the infrastructure within. The company spent $27 billion in capital expenditures just over the last year, turning free cash flow deeply negative. That cash spending is expected at $29 billion a year over the next 3, and with cash flow not forecast positive again until 2029. Over $114 billion in infrastructure spending, and I found 3 companies getting their share. We can start with Advanced Micro Devices, ticker AMD, up more than 40% since I started recommending it in February. Oracle keeps expanding on its general-purpose compute on AMD's EPYC, recently announcing the 5th generation E6 shapes to be used in its cloud infrastructure. Oracle's own blog marked the announcement, calling AMD's CPUs a new standard in performance, with 33% more compute and memory, and 2 times the network bandwidth. Translation, even as Oracle works with Nvidia in those headline accelerators, the boring but huge baseline compute jobs are going to be built on AMD gear. Next is the power to run these data centers, with Bloom Energy, ticker BE, already up 730% over the past year. Power is now the gating factor for AI capacity, the big bottleneck, and Bloom has a collaboration with Oracle to deliver its on-site solid oxide fuel cell systems in as little as 90 days. Not only is that fast power on demand, but it's cleaner, reliable, and cost-efficient, which is going to win more partnerships for Bloom. But the number one beneficiary of Oracle's booming spending, the stock I'm buying above all the rest, is Arista Networks, ticker ANET. Late February, I highlighted Arista as one of the top tech stocks to buy in that AI theme based on the bottleneck in networking infrastructure. Shares are now up 36%, and that networking demand is still a big player here in cloud spending. Oracle has publicly reported that its AI infrastructure is based on Arista's EOS-based switches for back-end training, and it endorsed Arista's cluster load balancing to improve throughput on its networks. It is only through Arista's microsecond class latency and load balancing that Oracle needs to deploy its superclusters for full performance. Looking at the stocks I'm watching this week, cybersecurity stocks got a big bump last week when CrowdStrike Holdings, ticker CRWD, increased its revenue outlook for the next year, now saying that net new annual recurring revenue, ARRR, would jump 40% in the second half of the year. Analysts are forecasting overall revenue growth for the company up 21% this year and next, and all this is from strong industry growth of 12% as cyber threats continue to be a pervasive risk for companies. Nearly 2 in 3 companies were hit by ransomware attacks last year, and that number is almost 3/4 for those larger companies, with the average cost of an attack at over $5 million. Cybersecurity is the one place companies cannot afford to cut. CrowdStrike was up 15% last week on the update, but this is industry-wide and why cybersecurity remains my favorite long-term growth theme. The 5 cybersecurity companies I hold: CrowdStrike, ticker CRWD, Palo Alto Networks, PANW, Fortinet, FTNT, Zscaler, ticker ZS, and Okta, ticker OKTA, were up an average 7% just last week and are up as much as 88% over the last year, with 4 of the 5 beating the overall market. Now, I like CrowdStrike and Zscaler on their competitive advantages in the industry, while Palo Alto and Fortinet are just too cheap to ignore. Okta has been the laggard on return, but there is an undiscovered potential here in its dominance in the identity management space. I'm also loading up on Advanced Micro Devices, ticker AMD, which fell as much as 5% initially after the news that Nvidia would be investing $5 billion in Intel to manufacture its CPU chips for data center and consumer segments. Now, I'm going to highlight next why I think the market is making way more of this deal than it will ever be, but we see it in AMD's stock reaction, rebounding from the day's low to close basically flat for the week. The fear here is that Nvidia helps Intel pass AMD and those CPU chips for gaming and PCs, while Nvidia remains the de facto leader for GPUs in AI. I've been recommending AMD since earlier this year when it was around $100 a share, and while it's not nearly as cheap here as my $108 average cost, there is still reason to believe this one can go much higher. First of all, to think that Intel can go from design dud to dynamo in less than a few years, even with Nvidia's help, that's comical at best. Second, continued capital spending on AI like we talked about with Oracle, and the transition to inference from training models is still going to push AMD to its forecasted revenue of $40 billion through next year. Now, AMD is no longer the dirt cheap valuation, around 6.5 times sales when we started buying in February. But if we assume even an 8.5 times price to sales on that $40 billion in forecasted revenue, that is a $340 billion market cap, or a $207 share price, a further 32% upside from here. And let's talk about Intel, ticker INTC, which was the big news last week with the stock up as much as 30% after that Nvidia deal was announced, but then giving back some of those gains to close the week. I know a lot of investors have rushed in to pick up this value stock, but I want to talk about why I think ultimately it disappoints investors, but may end up being a good thing for the United States. The deal sees Nvidia investing $5 billion as a lifeline into Intel and using its x86 architecture for computing packages. It could help both grab a little more market share in that CPU space, but it does nothing for Intel's biggest problem, getting its manufacturing foundry project off the ground. You see, more than 50% of the world's semiconductors are manufactured by just one company, Taiwan Semiconductor, TSMC, and the company is estimated to produce over 90% of the high-performance chip market. Under former CEO Gelsinger, Intel got the bright idea that, hey, if it can't compete in chip design against AMD or Nvidia, why not open up a new front and try competing against TSMC in manufacturing? The experiment cost Gelsinger his job and destroyed over $100 billion in investor value, and $5 billion from Nvidia isn't going to save that. It's why analysts were quick to cut their rankings on Intel after the stock spiked last week, and why it's down 10% from that Thursday peak. Intel burned through $15 billion in free cash flow last year, and this is no more than a band-aid on a bullet hole. So no, I don't think this is going to save Intel. A breakup is still needed, and investors will probably be disappointed over the next year or two at least. Longer term, though, this could be a net positive for the US as Intel struggles but is eventually more successful at building out that foundry chip manufacturing. It is a national security issue that Taiwan Semiconductor produces most of the world's chips when a move on the island by China could put all that at risk, so we do need an alternative. It's going to take better part of the next decade to get there, and more than just a band-aid $5 billion in the process, though. Showing you the bigger picture with the Sector Spider sector tracker. 5 of the 11 stock sectors closed higher last week, with the typical risk-on sectors like tech, consumer discretionary, and communication services stocks doing well, but not much else out there. Now, you're going to hear pundits talk about how just a small group posting positive returns isn't a good sign for strength of the market. I'm not worried about that lack of breadth just yet, as everything else points higher, but if it continues through October, I would start looking for value in some of these underperforming sectors. On a longer trend, the consumer staples sector is now the only group in the red over the last 3 months, but is likely to continue to outperform. Wall Street is talking about a jobless expansion, where unemployment continues to increase, even as the Fed cuts interest rates and propping up the economy and corporate profits. A weak jobs market could see consumer spending stagnate at best, so while the rest of the market could do well, stocks in the consumer staples sector should be avoided. Updating our stock market outlook, the big Fed meeting came and went last week without nearly as much drama as investors expected. The market breathed a collective sigh of relief on the restart to lower interest rates, but stocks barely budged with Wednesday's meeting. The CME FedWatch rate tool, which shows market expectations for future rate cuts, shows investors are expecting another 2 cuts this year and 2 more at least next year. This is part of the story to those new all-time highs in stocks, the idea that interest rates could fall by as much as 1.5% or more, lowering those costs of borrowing to support the economy. The other market-moving theme is, of course, AI spending, and for how long can it continue to lift those tech stocks? So I want to talk through my thought process on each of these and why I think this bull market keeps on charging. We will hear from nearly every president and governor of the Federal Reserve this week, with 10 speeches scheduled, including Stephen Moran's first as a governor of the board. In his Monday speech, he's going to lay out why he pushed for a larger half-point cut last week, and I expect the rest of the speakers to highlight why they voted for a smaller 0.25% cut. Whichever is more compelling, the point here is we are in for lower rates over the next year. Digging into the meeting report from the Fed, while everyone loves to talk about that dot plot, or where each Fed member thinks rates are going to be over the next few years, comparing this with earlier plots to see where the Fed thinking has changed, an easier way to look at this is through the distribution graphs towards the back of the report. This shows in the blue bars here where the Fed members see the target interest rate in each year against a dashed line of those prior estimates. In last week's report, comparing where the Fed members saw the interest rates ending up in the last meeting, that dashed line there, versus where they now see them, this current meeting in the blue bars, there is a clear shift to lower rates. After the recent trend to a weaker jobs market, the Fed is quickly rethinking its views to lower rates. We're going to see an important part to that in the personal consumption expenditures, the PCE report on inflation on Friday, with expectations for inflation to have increased only slightly to a 2.7% annual pace from last month's 2.6% report. The core measure is expected to remain right around 2.9% inflation year over year, well above the Fed's target of 2% price increases, but pretty modest so far. And while this and other inflation reports over the next few months might spook the markets here and there is a reason to stay strong and buy any dips the market gives us. Higher inflation will continue to scare investors that the Fed might not cut rates as quickly as expected. Now, remember, the Fed has to balance full employment, so cutting rates to boost the economy, with stable prices, not stimulating the economy so much that it causes more inflation. But if you think through this, there is reason to believe that inflation isn't going to get as bad as feared. A weaker jobs market and higher unemployment is going to mean wage growth remains modest at best and is going to help keep that overall inflation from rising too much. While that does mean overall economic growth will be sluggish, corporate earnings should continue to rise as companies cut those staffing costs and see interest expense fall on the lower interest rates. Now, I know it's a long economics nerd way of thinking about this, but it's a really positive scenario for stocks. It means inflation shouldn't get so bad that it forces a pause in rate cuts, while lower rates should help the economy from falling into a recession. And as for that other story driving stocks, the recent news of further AI spending by OpenAI and Oracle proves that theme isn't slowing down. OpenAI alone is planning a $100 billion investment in just backup servers over the next 5 years, and JP Morgan still estimates total hyperscaler capex in the trillions through 2028. Continued investment in AI infrastructure for data centers and software that's going to support revenue growth for the tech sector, now 34% of the S&P 500 market index. Besides the direct beneficiaries of all of this, the rest of the market should also benefit from that strong investor sentiment and an appetite for risk, pushing the stocks further into all-time highs. Join me on the Blossom Investing app, free with the invite link below, and join us at the New York or Chicago meetups in October. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.